Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, January 9th. The US yields push higher over growing debt and inflation concerns in the US under Trump presidency, while British bonds are aggressively being dumped right now on growing concerns about the British government's tax and spending plans, and hence will make these very plans almost impossible to achieve for the Labour government. So the sell-off in US Treasuries continued yesterday over concerns that, Donald Trump's presidency would boost spending and debt and also inflation in the US over the next 4 years and make the Fed's job of bringing inflation back to the 2% policy target more difficult. So the downside pressure actually slowed a little bit after the ADP report from the US showed that the US economy added slower than expected new private jobs last month, but the concerns continue because note that the minutes from the latest FOMC minutes that were released yesterday, they clearly said, without explicitly mentioning a name, but they said that the upcoming changes in the US immigration and trade policies may eventually require a policy reaction from the Federal Reserve. And that reaction would obviously be in the form of less interest rate cuts this year to contain that expected rising inflation. Voila. So the US 30-year yield flirted with the 5% mark yesterday for the very first time since November 2023 before easing, and the US 10-year yield spiked above the 4.70% level for the very first time since April and is set for a further advance toward the 5% psychological mark, a level that will probably make it an interesting buy target for the US 10-year papers. Now, obviously, strong economic data could accelerate that journey towards the upside, while a weak economic data from the US, unless alarmingly weak, may not really prevent it. And the US is not the only place struggling with the rising government bond yields. Mind you, the UK is struggling big time as well. Now, remember, the 30-year gilt yield in the UK advanced to the highest level since 1998 earlier this week. And yesterday, the 10-year gilt yield advanced to the highest level since 2008 during a very, very aggressive sell-off in the market and actually broke above the peak levels that were previously reached during the Liz Truss historic mini-budget crisis. Remember that time? I'm sure you do. And again during the summer and autumn period of 2023 on tighter monetary policy from the Bank of England and also on growing fiscal concerns under the Conservative government of that time. But today, the UK's demands are back due to, fiscal concerns again. And it reminds everyone of the chaotic Liz Truss period. Chaotic Liz Truss days where, markets around the world, investors had lost confidence in the UK government and its spending plans, and the aggressive sell-off that we had seen in the gilt market had obliged the Bank of England to step in to cool down the worries and the sell-off. So Truss government had fallen, remember, after the crisis, and things went downhill after that for the Conservative government, resulting in a strong Labour win in the elections that followed. But the problem today is that the UK's newly elected Labour government was actually supposed to save the country, improve the country's deteriorating finances, and even boost growth in the UK and even investment. And to do that, they need the market's support, a thing that they have difficulties holding on to these days. And if they lose the market's support altogether, the game is over for the spending and growth boosting plans for the UK's government, because the less the market wants to finance the UK government's plans to spend and to boost growth, the higher the borrowing costs for the UK companies, and the higher the borrowing costs for the UK companies and the UK economy, the higher the taxes and the lower the spending should be. And that is obviously not good news for the pound. So The pound tanked to 123.20 level against a broadly stronger US dollar yesterday, but this time it's also aggressively sold off against the weak euro. And that, to me, is now a clear sign that it's certainly time to step out of long positions in sterling and eventually wait until the dust settles. On the equities front, the British FTSE 100 index actually recovered its earlier losses yesterday as a softer British pound is supportive of the FTSE 100 companies' valuations because they actually make most of their revenues outside the UK. While the smaller British stocks are, obviously more vulnerable to the political uncertainty and the rapidly rising yields and the rapidly rising borrowing costs. Happily, though, many investors out there still rely on the Bank of England's power to calm down the game if things get out of control in the UK politics, and that's perhaps limiting a further sell-off in British stocks altogether. Across the channel in the continental Europe, the euro-dollar also dived at yesterday's trading session and traded below the 103 psychological mark on the back of a broadly stronger US dollar. Across the board, the pair is now consolidating near this level this morning at the time I'm talking here. Whether it will continue its journey toward parity or make a U-turn toward the 105 psychological level depends. It depends on where the US dollar will be headed next. Right now, the US dollar remains bid across the board, and that's on the back of a hawkish shift that we see in the Federal Reserve's policy outlook versus in no particular change to the European Central Bank's softer monetary policy stance. But a soft-looking set of data from the US could rapidly change that dynamic and slow the US dollar's appreciation near the current levels. In equities, the STOXX 600 index was gently rising yesterday morning until it wasn't anymore. The data actually released in the Eurozone yesterday show that the German factory orders slumped by more than 5% in November, while the business climate and consumer confidence across the Eurozone countries deteriorated in the month of December. And that's obviously no good news. Also note that the producer prices jumped more than expected in November. The PPI, for example, rose to 1.6% in November from 0.4% printed a month earlier. Now that's a big jump, but a big part of it was already priced in, mind you, as the market expectation was an advance in the yearly PPI to 1.5%. But still, the combination of weak sentiment and rising price pressures is never good for stock appetite. Still note that for the contrarians, the German DAX index is actually expected to print the biggest EPS growth this year, because earnings per share in the German DAX are actually expected to grow by 10% this year. They're coming from a low base, so it's possible, and it's going to be followed by the Swiss SMI index, expected to deliver 9.5% EPS growth, and France's CAC Garonne, that is expected to print an 8.8% EPS growth this year, according to the data gathered by Bloomberg Intelligence. Now, the British FTSE 100 index is only at the 5th place, from the top in this list that I'm citing, with an expected earnings per share growth of only 5.9% during 2025. But I think that a possible U-turn in energy prices could change that expectation, because crude oil made a great start to the year. The barrel of US crude actually remembered what it was feeling like to sit above the $75 per barrel level for the first time in a while before returning back to the $73-ish levels. But from a technical perspective, crude oil is now in the medium-term bullish consolidation zone, and it should remain there above the $72.85 per barrel support. But obviously, the growing concerns regarding China's inability to boost growth there could eventually limit the upside potential in crude oil into the 200-day moving average that currently stands just above the $75.50 per barrel level for the US crude. And speaking of China, the trade tensions there get tenser between the US and the latter. Earlier this week, China said that it would curb exports of metals like lithium, for example, that are used in making batteries. And yesterday, Joe Biden's administration announced additional restrictions on AI chip exports toward China. And that was after blacklisting Tencent and Kettle, which is one of Tesla's key battery suppliers, the day before. So Nvidia dipped on the news below the $140 per share level after the bell, while quantum stocks tanked after Nvidia CEO Jensen Huang said that he doesn't see quantum computers' usefulness before 15 or even 20 years. Now note that the US stock markets will be closed today as day of mourning for the ex-president Jimmy Carter, while the bond market in the US will close at 2 p.m. New York time. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.